Morningstar Investment Conference, and today Platinum's Andrew Clifford joins me. Andrew, hello.
Thank you.
Andrew, in your presentation there was an interesting slide about your portfolio exposure, which looks like it's very weighted towards China. What sort of companies are you investing in that country?
Yeah, so the sort of companies in China that we have, they're probably three or four distinct groups. One is insurance companies, both life and property and casualty insurance. And China's at an interesting stage in its development where people have now accumulated enough wealth that they actually have something to insure. So whether it's their life and concern about if something happens to them, what happens to their family, or it's just that they're accumulating household goods, cars, and they want to protect these. But of course, it comes down also to the nature of these businesses. This industry is consolidated to a small number of players. As competition has fallen away, they're very profitable. And of course, for us, it's always important the price we pay. So we're buying, for example, PICC, which is the leading property and casualty insurer, on a PE of about 15 times. And we think that that business can grow very nicely. It's very profitable, has underwriting profits and so on. Another group are the internet or e-commerce plays. So there's a range of them, from Baidu, which is like the Google of China, growing at 50%, 56% type growth rates. Its earnings are suppressed a bit because, like many of these companies, it's still investing in new ventures. But it's on a PE of 27 times. But we think earnings can actually outgrow over the next 5 years that top line growth rate. So we actually think that's a pretty interesting one. There's a range of these companies that are in the portfolio, from Youku, which is a bit like a combination of YouTube and Netflix, if you like. Tuna, which is a bit like the TripAdvisor of China. There's another group of consumer companies. One of them, Mutai, is the maker of the liquor of the same name. Very strong brand name. Historically has grown at sort of 20%, 15 to 20% growth rates the last couple of years. With the corruption crackdown, it has slowed down. But again, we're buying that on a PE of 17 or so, 17, 18 times this year's earnings, which we think, for the type of the quality of the business and the growth rate, these are fantastic investment opportunities.
Andrew, are you concerned about any of the risks coming out of China?
The risks in that in China, clearly, relate to the problems in the property market and the bad debts that, are yet to surface for the banks. But, having said that, this economy has slowed. I mean, property construction has come to a grinding halt, really. And yet, if we look at variables like parcel deliveries, last year they grew by over 50%, and in the first quarter they continued to grow. Other things like overseas travel grew by 20% last year, continues to grow the first quarter. So it's very clear in a whole range of things. The box office at the movies, again, 30% type growth rates, we're continuing to see it. So despite whatever's happened in the property market, and there will be people who have lost money there, other parts of the economy continue to surge ahead.
Andrew, in the presentation you also mentioned you were underweight US. So aren't you seeing any opportunities in that country, or is it about valuations?
What the world has done in recent times, investors have done, is that they're so focused on avoiding risk. We've gone to markets or assets where there's high degrees of certainty. And so we see that in the bond markets, where people would rather lose money each year on a German Bund than take the risk of investing in something else. And that's flowed through to some equity type assets where there's a high degree of certainty. And certainly the US, with its focus on many consumer staples names, the Procter & Gamble's, and these type of companies, we think, we're not going to particularly predict that those stocks fall particularly hard, but we just think the potential returns are very uninteresting. And indeed, we do think, on a company by company basis, they all face particular risks. So we just think there are just far more exciting and interesting investments to be had, much better valuations to be had in places like China, but also Korea, India, than there are in the US.
Finally, Andrew, just a sector question. You mentioned that the energy sector is an interesting place. Can you explain further?
Well, it's exactly the sort of thing, that we like areas that have fallen out of favour. The oil prices had a very big fall. Our analysis of that commodity market, we think that really at current oil prices, you are seeing shutdowns of production that will in time right the balance, and we really need an oil price of $80 or so to get supply back up to meet sort of current levels of demand. Somewhere like China, it may be growing more slowly than it has, but it will, energy it will continue to consume. It's going to be a long time until the electric car has any kind of impact. So, we think oil really needs to settle at a price above $80 longer term. Many share prices in the energy sector have fallen, so it's an obvious area of investigation. But, we haven't done anything of great substance there as yet.
Andrew, thanks for your time.
Okay, thank you very much.